So welcome to Just Think About It with Nadine and Ben, presented by Wall Street Beats. I'm Nadine Turman.
And I'm Benjamin Bry.
And we're excited to launch our initial episode with you today. So with us today, we have two longtime Wall Street veterans who both worked in global capital markets for over 3 decades to help explore whether is this 2000, 2007, 1987, 1995, or something entirely new. We'd like to welcome New York Times bestselling author and founder of the Bear Traps Report, Larry McDonald. And we also have Rupert Mitchell, who is former capital markets and derivatives leader at Goldman, Citi, Jefferies, who's worked across the globe with an excellent understanding of macro, especially in Asia Pac. So welcome, both of you.
Thank you, team.
Thanks, Nadine. Thanks, Ben.
All right. So today, like in the spirit of the show, we want to start off with what is the actual foundation of the bull market? Like if you're a bull, if you're somebody who's long risk and you want to be thinking a couple of years forward and you want to be long from this point here, we're going to get into all the why we think maybe there's other things, but let's define what the bull case is and what the premises are underlying. So maybe we'll start with you, Larry. What do you think that you got to really believe to be a bull on risk right now?
Well, I guess the bull case is productivity, one of these AI-driven productivity explosions that it's kind of like the birth of the internet, same excitement. You can call it an industrial revolution 3.0, but that kind of dynamic that raises, the GDP forecast looking forward and also potentially changes the labor market in a different way. I think that's it. I think that it's that kind of the belief that the economy is going to be supported by this new renaissance, this new industrial revolution.
Rupert, do you have any thoughts to add on what you think is necessary?
I think absolutely. I think that is, if you like, the call option, but there's a put option element to it as well, which is I think that there is, there's muscle memory that central bankers and central bank liquidity has you back if things turn around. I mean, we've been in a buy the dip world for 3 years now, and I think there is an innate assumption that the central banks have got your left tail covered. Whether they're right or not, I don't know.
Yeah, it's amazing, Ben. Like we were on a chat with institutional investors, and we talked to a lot of clients around the world, and almost the universal conversation from almost everyone is that what Rupert said. It's like we're going to get through the election all the way through liquidity. They've issued 70% of U.S. Treasury issuance been T-bills. That tells you what Rupert's getting at. But everybody thinks that we're just going to coast all the way through the election, and then there's some type of problem. But from now to then, the view is almost unanimous that liquidity just drives us much higher.
And there's also this election.
Right? Like we saw Goldman, right. You had Citi. I mean, B of A. Everybody's out with we're going to hit all-time highs at the end of the year. But you look at their chart, it's like it looks like this, and then it could be like this. So they're saying we're estimating the average. It's going to be weighted average up here, but they're still showing you it could go down, right? Double digits. But no one's focused on that outcome. Everyone's just focused on kind of what you guys are saying, that there's a put on this market in the economy. And let's all think about all the great things that could come from it and weighted average that up a bit.
Yeah, and also with all these things, you've got a linear path to a point in price without any commentary about how you get there. Ultimately there's a right drift to all asset markets over time. And so, yeah, given the right length of time frame, yes, we can see higher prices, but the path that you go through to get there is certainly uncertain.
And what about margins? We're sitting at pretty much all-time high margins, and I get the productivity thing, but one of the drivers has been net interest expense has gone down. And that's starting to revert, right? Because even if base rates come down, I would have posited that they're going to go down because things are going to roll. And so credit spreads will go up. So as these guys come to the maturity wall and maybe they're not getting as much on their short end, that's going to be another thing that's, it's tough. I mean, where's the margin case, Larry? Like we're sitting at 15, 14%. Like how much higher can margins go?
Well, it's important to note, really important, in the observation that I'm getting from the institutional clients in the chat is that since Friday, IGs and high yield have really diverged. So in other words, the whole year with the bull market, triple C's led, high yield led, investment grade bonds. But in the last week, you're seeing not just the transports underperforming, not just U.S. Bank Corp, or say super regional banks are dramatically underperforming the S&P like over the last month, and you've got the transports, and you've got also a lot of consumer discretionary names. But for the first time this year, really credit is not confirming the latest move up on equities, whereas all year long, credit was kind of leading the way higher.
Yeah, and you've seen dispersion within even the high yield. The triple C's are trading very wide to the double B's and the B's, and some of that's from the telecom names that are having some issues. And so, but yeah, last week you saw Euro financials, Euro credit, all kind of blow out. We started to see investment grade bop up a little bit. So yeah, I mean, the credit thing is the thing I think is the most interesting thing to watch, because that has been all year strong as an. And that kind of gets back to the top line part, to get back to the definition of the bull. What's going to drive growth? You know what I mean? Like if we were to say productivity, okay, maybe, but what if that's at the expense of people's jobs? So the income side gets hit. Like where is it just the government? Rupert, what do you think?
Well, I think I think people are finding this economy really tough to call at the moment, because how you feel about the economy really depends on where you sit relative to the fiscal fire hose, right? I know so many businesses that are benefiting from the Inflation Reduction Act or other things tangential to that, but there are plenty of businesses that are sucking wind at the same time. The twin track economy has become a bit of a cliche now, but I think you see it everywhere. I'm based full time in Australia, and I'd say, the white collar recession is absolutely there to stay already. The US economy is structured completely differently to the other Western economies of the world, largely as a function of 30-year fixed rate mortgages on the consumer side, and the fact that you've got these very powerful large cap tech companies in the equity market propping that up, and you've got an otherwise a listed corporate universe that was pretty smart about terming out its debt structure at fixed rates during very low interest rates immediately after COVID. And so the lag effect of these higher rates is taking its time to be felt.
But I mean, just back to it though. I mean, where's the growth? Like, what is the growth though? I keep coming back to, like, if you're a stock investor, you need growth, right?
Well, I mean, you've got fiscal deficits that's going to be a driver of nominal growth for a start. Beyond that, we've talked about productivity potential. Beyond that, the everything else is headwinds to my mind.
Larry, you think anything else? I mean, is there any magical fairy that's going to come out and give us some growth?
Well, that's the thing about the fiscal side. Everybody knows that at the end of the day, they look back at the 2008. That election had a big impact on the obviously the banking crisis had a big impact on the election, and then now we had a banking crisis over the last year. So they've just gone all in fiscal, and so. But what's amazing is the growth really going to come in on the inflation side. So in other words, we're getting this kind of revival in inflation, and like every single CPI number, there's a different component that kind of keeps it a little bit more elevated. And so I think we're in this renaissance where you get this much higher inflation track than historical, but everybody's really in the last decade's portfolio still. But if you look within the market, like software, there's this weird rotation going on from long duration equities over toward some value plays. But overall, there's money's moving toward commodities, but because of that, higher for longer promise from the Fed, that's keeping that dollar higher, and that's actually stunting global growth because the dollar is so strong. So that's the weird thing is we've done the fiscal overdose, but global growth because of the dollar is now kind of stressed.
Right. And in your book, which by the way was excellent, you talk about the weakness of the dollar. But how do we get there, guys? How do we get to the weak dollar? Because I agree, it just seems like we're in this late stage of District 1 takes over. Basically, did we lose Larry again?
No, I'm here.
Oh, okay, sorry.
He's rearranging his books.
My buddy David Dredge has coined this whole thing, the Hunger Games. There's too much supply, not enough demand, right? And so we have all these outer realm, like District 2 and 3, let's call them maybe Europe and Japan, and these those assets are getting hit first, and then these guys are coming into the dollar. So kind of like how Reagan's Imperial Circle happened in the 80s, where they ran big fiscal deficits and they had high rates, and the dollar went, I think the DXY went to 160 or something, right? So do we have to get through that period first where we have high oil, high dollar, everyone else gets hit, and then the Fed eventually comes in, because the U.S. economy clearly has starting to slow. There's no question. I mean, what are your thoughts on that? How do we get to the other side? Bridge us a little bit.
Well,
Who do you want to?
I would say that to me, it all comes down to this, the trade for the rest of the year. Higher for longer is a promise that central banks are using their vocal cords now. They hiked rates for over a year and a half. Now this higher for longer thing has been going on for 9 months now, and maybe more. And so that higher for longer, that keeps the dollar up. But at the same time, if you look at U.S. Bank Corp underperforming the S&P by 50%, this is the 5th largest bank in the United States. So the divergence between, say, JP Morgan or the XLF, which is the financials, and some of these super regional banks is spectacular. And so there's this creeping credit crisis that's come on the consumer side. Everybody can see Darden Restaurants, McDonald, any company that faces the bottom 60% of consumers. It's just, just Target. I can put to 70 companies, but everybody's hiding out in Costco and Walmart. So we're seeing this incredible divergence between a few companies that, your Costco's and your Walmarts, but the rest of retailers are all in these huge, horrific Dollar Tree stores, Dollar General, Big Lots, so you've got this we're in a 1980 style recession where it basically starts taking out, the bottom 40%, the bottom 50%, the bottom 60, bottom 7. At some point, it gets up toward that upper middle class, and that's where we're coming. That's where we're getting closer to that, and then you go into the real recession. But that's kind of like the 1980 style recession, whereas Rosenberg and say Lacey Hunt and a lot of these bond guys have been looking at that the last 10 to 20 year recession, where it's not driven by spectacular growth. It's not driven by inflation. And I think that's the big confusion in the market.
And Larry, I think we're talking about the $5 value meal on a McDonald's this morning. I think that's what you're referring to.
Yeah,
I think the point on the Costco Walmart things, they're also benefiting from upper middle class consumers that are trading down to them. So they're benefiting from that effect. I mean, I was going through this thought exercise. So a lot of my nephews, nieces, and godchildren are sort of turning 18, 19 now. And I historically used to buy them en primeur wine when they were born as a christening gift. And so they're all turning around and they want to go interrailing around Europe, and they're saying, can we sell this claret? And I was having a look at where fine wines are trading right now, and at the index level, they've had a major drawdown, quite a significant drawdown since late last year. But I tell you what, the tradable market is 15 to 25% below where the index is suggesting. So there is absolutely no liquidity at the luxury end, and you can see the same in the luxury watch market. So I think these lag effects are kicking in much more insidious. It's certainly, I mean, you can you can get a forward view of what's going to be happening in the US from what's happening in Europe and the rest of the world, where the rate pain is already being felt in current accounts, because they're paying the rate. Yeah, they're not stuck in these low rates from 2-3 years ago. So that can only last for so long.
And
Rupert,
this,
so one of the things, I mean, it's funny because we couldn't stay on the bull case even as long as I thought we could. We were
I was worried about that.
cracks came out so fast because that's what everybody loves. But I mean, I put it to you guys is that I think that Ben hinted at this, which is like, how do you get the timing right? Because I think that's the hardest part for folks, right? Because, if I rewind a year ago, I didn't think that we would be at all-time highs now still, right? Because some data's come out and things are slowing. You have bifurcation of consumers. You kind of hit that JP Morgan saying things are slowing. You hear all of these things, yet the market is at all-time highs. So how do we get the timing right? Are there signals that you guys look at, certain data points, or do you say it's impossible? Like, how does someone create the actual execution of these views into a portfolio, because timing matters so much?
well, I think that, okay, the bottom line is, when do you put money to work, right? When do you want to really put money? And all I know is when the transports are underperforming the way they are, and when the regional banks are underperforming the way they are, and then when big consumer discretionary names are underperforming the way they are, and then high yield is underperforming, that tells you that, and you've got the whole breadth situation, which we can go on. I mean, everybody knows the breadth. I mean, we've got new lows creeping up on the New York Stock Exchange almost every day, like a higher level of new lows. And you've got like this stat in the last couple of days where NASDAQ makes a new high, but within the NASDAQ, there's more new lows than new highs.
Right.
So there's like all these things that tells you that something is very like a tradable event. Like, as long as I've been in this business, that tells you like a tradable event is very close. Now, and another crazy thing, the premium, say, of the NASDAQ or the S&P to the Dow, that's in a category 5 capitulation for say the Dow Jones Industrial Average, or if you look at, say, equal weight S&P versus S&P, that's in a category 5, like we're talking like Hurricane Katrina type capitulation score that we're seeing here. And we're coming up to a quarter end and month end. So let's think about timing, right? So a lot of times, so if the Dow Jones Industrial Average is underperforming, say, the Qs by a category 5, and it's coming into quarter end, month end,
Yeah.
when these option dealers are trying to pin the big stocks into that like option expiration, that $5 trillion expiration tomorrow, and it's quarter end, month end, right? So to me, because it's quarter end, month end, and you have this historic epic $5 trillion expiration all lining up at the same time, and we're seeing these capitulations go, to me, that everything flips in the second half of the year, where we go back toward where I think the higher market cap, the spread between the big guys and the little guys, that compresses in the second half, I think, with the highest conviction.
So Larry, like, are you calling for a reversal of the big guys, or just the fact that you can be melting up still, but the laggards are the relative winners? Like, what is the call here on that timing? Because you kind of said, okay, there's a flip, but is it flip and certain people are going down, or is it just other people get to move up the multiple game?
I've been looking at this in quite a lot of detail, and I think that in terms of market structure, we're not dealing with our father's market right now. And if you look at the impact of the much discussed dispersion trade on markets, and the impact of the multi-strategy funds on markets, where you've got whole cohorts of hedge fund pods with our long single stock vol and short index vol, and we are looking at record levels of low implied correlation and low implied volatility.
Right.
The way
right.
I've been approaching it for myself, I mean, listen, I'm still suffering from sort of PTSD of owning too many NASDAQ puts last year, but the reality of those negative carry trades in equity indices, it's been brutal. And I took a view this is going back about 3 months now, that what I was going to do, I was just going to manage an at the money straddle in the S&P, right? 30 to 50 days, constantly moving up or down the strikes on the straddle to spot, so that I was exposed to a blowout in volatility and a blowout in correlation. And that actually, as a strategy, has allowed me to carry a hedge against these two risks of higher vol, lower correlation, or so increased correlation rather, in a positive manner over the last 4 to 6 weeks. Now, listen, I'm not going to retire on that kind of P&L, but it allows me to not only just stay in the game with my hedges in place, but if I want to take a shorter term swing view on directions in the market, I can, stay in the calls a bit longer, right? By that, I mean by maybe a few days to a week, and then hedge myself back up to the market. And that's been how I've approached it.
And when you think about implied correlation, you're absolutely right. So in other words, look at Costco, right? The last 30 years, Costco has been this high above its 200-day moving average for less than, I think, 2 weeks, right? But at the same time, all the, dozens and dozens and dozens of other retailers are making these new lows. So you've got this divergence between kind of like the hideout stocks. Like, look at the spread between American Express and Capital One. I mean, it's literally the widest since COVID. So in other words, people are hiding out in American Express, but they're afraid to own Capital One and Discover because of this kind of weak consumer weakness on the bottom 60%. So that's all these divergences tell you that the hideouts in the second half probably come down toward, and to get back to what Nadine makes up the most important question, like, is everything going to go down, but the hideouts come down more, like the Costco's and the Mag 7, or is it, or do we have like this breadth improvement where the bottom part of the market starts catching up? And it's so hard to call. But I want with the highest certain. All I know is it's not just the top 5 stocks are bigger than the entire market was at the top of the market in 2016. That just shows you the crowding, and we know the top 3 are now 21% of the market, right? But the top like 6 or 7 are bigger. And Chris Bloomstrand said this in a little tweet, but he's a great value guy. But so the top 6 or 7 are bigger than the entire market was in 2016, and he was like, and that wasn't a market low.
But I think it gets us back to the original economy point. Until people that pay major 401k payments every month, until those flows stop coming in, then money's going to carry on finding the Mag 7, right, or the Mag 3, or the Highlander, as we call it now. And I think that flow is really the trigger ultimately. I don't think that the machines are going to wake up one day and say maybe we shouldn't buy Nvidia anymore, right? They're just going to be not in receipt of as many funds as they had before, and then those corporates still have plenty of buyback firepower. So I mean, it's if there's a window of weakness, it could possibly happen in a buyback blackout period,
which
possibly.
we have right now.
Yeah. But where is that now? Where's the buyback blackout?
We're just getting up to it right now. So, to talk about timing, like, let's just put this together, right? So the divergence, like Nadine and I are creating a convexity product to take advantage of the tight credit and some of this cheap vol. But like, you look around, single stock falls high. The divergence is that Larry's great. He is the best at charts of comparing various stocks and saying, oh, what's
and all
going
his
on
stocks
here?
are green today. All his stocks are green today by the looks of things. He's having a good day.
Right. So
unless you've got a Chinese monitor.
Yeah.
It works the other way.
But you see this, and historically I've gone back and you don't see it really catch up. You see some kind of like event, and then that's that. But then these stocks lead, right? So 2020, the small caps and the value stuff led until May of 21 with Evergrande blowing up. And then, as you guys are all familiar, in 02, that was when all the value guys made their names, Ackman and all those guys. And those stocks were already discounted. And I did
Well,
it in
all those value guys that are now momentum guys,
Yeah.
right?
well, you gotta change with the times, right?
Yeah, exactly.
But I mean, it's right though, because I actually did a cross-sectional analysis of the S&P going back 10 years of every stock. So it took me a little while to do it, but like the average stock in the S&P is down 20% or 22%, and the median, or the median is, and the average is down 18. So like, there's a lot of stuff that is re-rated. You know what I mean? Like, and so yeah, maybe they'll go down a little more if there's a liquidity thing. But yeah, like let's just do the last thing on the timing real quick. We have the elections in Europe. We have Trump jail sentencing on July 11th. We have the blackout window. We have summer vacation, so weird liquidity. And then today, $5 trillion of OPEX comes offline, or tomorrow, I'm sorry. And, we saw some shooting stars in the market today. I mean, NVIDIA touched 140, and now it's back near to 130. That's usually, Larry, you're the expert. You tell me, is the shooting star usually something you look for at tops?
Well, yeah, NVIDIA had that candle on March 5th, I think it was. And that was a spectacular, I think it was a $260 billion candle. Now this one might be bigger because because NVIDIA's market
See,
cap
I think we need to be really careful with some of these old measures of market function, because you need to VWAP the candles, because all of the activities happening at the close these days, the individual daily candles are actually meaningless. You should really be just looking at the last 25 minutes of the day and figuring out what the VWAP is there.
Well, the only point I make is that candle on the 5th of March was very tradable. In other words, it wasn't just, it was NVIDIA, it was like a lot of the big semis. Supermicro computer had a big, so they all had this enormous candle, and then it was tradable. In other words, you had like, I think a 15, almost 20% move down in some of these semis, and then, but that it was only tradable for a month and a half. And like to your point, now we're back up at the all-time highs for some of the semis. But
so I think to go back to Ben's question, which is, do political event risks change anything for markets? Now, I certainly, I don't. I think we've already been shown the proof that Trump sentencing or Trump convictions is a nothing done as far as markets are concerned. I think that ultimately markets have got every single election wrong this year, literally every single one. Maybe we can talk about some of the EMs later, because I think they're interesting. But my sense is that, if you look at the shock with the European Parliament elections last week, yeah, we had a little spook event in the French rates market. It didn't translate into an FX event, right? We didn't get our dollar napalm run, as Julian Brigden likes to call it. It was actually incredibly calm. I mean, I think that we're all in the narrative business, and so we like to look at cause and effect. But I don't think this machine is pricing event risk in the same way that we would like to want to understand. I think that it comes back to, is the money coming into the 401ks? Because that's what's propping up. And now credit markets and rate markets are slightly different, because you've got the sort of the hand of God of central banks that will be, furiously pedaling under the water to ensure that those markets do continue to function.
So Rupert is saying that, like, if you're going to pick on anything, just watching labor. Is that what you're saying? You got to be watching labor because
I think,
money goes into the 401ks.
Well, actually, I think what you want to watch is white collar layoffs.
Yeah, and it's interesting, the jobs report, right? So there's all this controversy. It reminds me when I started my career, and it was the household and the payroll were not corresponding, and the net birth, net death. It's like we're back. You know what I mean? And the net birth, net death is always lagging, and it's always making too much of the jobs.
And the revisions are crazy right now. I mean, I was just thinking as we were talking earlier. I mean, how soon are we away from a sort of class action suit against the Treasury because of the pricing of tips? right?
I mean,
If tips pricing is based on BLS data, which frankly is BS data, as is being proven every single month. I mean, I
got the
think there's a
L.
pretty good legal case for wrongful mis-selling of a fixed income product.
well, and also you saw Powell on the last conference call. He basically said that the payroll is overstated. It was incredible. I've never seen a central banker say that before. It was.
But should real rates using CPI be something that we talk about? I mean, we were talking about gold earlier. I mean, yeah, gold is completely detached from real rates. Well, what are real rates? You know, inflation is basically a number plucked from the air right now. So are we looking at the right number when we're looking at real rates?
Well, just one thing on that. My preferred measure of real rates is the SOFR rate minus the 2-year average CPI. Okay. And I think I sent this to you, Rupert, and maybe I didn't send it to you, Larry, but we're now just getting to positive real rates the last 3 months. And since the GFC, you know how many months we've had of positive real rates measured like that? 10. And if you do it 2-year average SOFR minus 2-year average CPI, 0. Okay. So this system can't handle
but
real
you're still
rates.
using the BLS input, though. That's your problem.
I mean, it's okay. Well,
Have you tried? I mean, the guys at Trueflation don't go back long enough. But have you tried using any alternative inflation input for that analysis? I think that'd be interesting.
I mean, I used to use the shadow stats data, where he would use the 1982 methodology, and it shows that inflation is just dramatically higher than what's reported. And the government's incentivized to do it, right? Less Social Security payments, like less interest rate payments. I mean, they run seigniorage. That's what governments do, right?
Look, maybe I can bring it. So one of the things that I think, I've read through your materials, which is really interesting, where you guys are finding opportunities. Because I think that we can all say there's cracks here. We're concerned. It's probably sooner rather than later. But in terms of your sweet spots, and maybe we'll start with Larry and then go to Rupert, are there specific investment areas either that you're finding that are contrarian, people throughout and you're going long, or that you think people need to be paying attention to, that they could start doing some work on or affect in the nearer term? So you have money, or you're trying to switch positions. What can people do now that you're finding interesting that not everybody's in?
Okay, so Intel is 22% below its 200-day moving average. The SMH is 44% above its 200-day moving average. 44% above for the semis, and Intel is 22%, 23% below. You'll never see that again in your lifetime. That's telling you if you're in the semi trade, you want to be buying Intel here. It's once again, this is the growth value thing.
Sure.
So we're getting a category 5 reading of value capitulation versus growth. And so you want to be long value, global value. That's the cheapest part of the market. And that's also setting up, because the month end, quarter end, that capitulation is climaxing now. So what we're seeing some clients do is sell like a 1-year call on, say, the SMH that's like $40, $50 out of the money. So take in that premium and buy a 1-year Intel call, right? Yeah. And so you're long the cheapest part of the semi basket, and you've got a whole bunch of secular potential tailwinds for Intel versus a very expensive rest of the semi sector.
I like that. I like the reason I like that, Larry, is I think there's a sort of buy USA mandate around reshoring, nearshoring in semiconductors. A lot of that money is going to find its way to Intel. The trouble with it is that with SMH, you've got a 38% bet against the Highlander and TSMC, right?
Right.
And so, that I like that. I like that as a pair. My sort of AI derivative bet against the Highlander is the utilities. and I'm short the XLU via a. I mean, it's not an aggressive structure. It's a modified call butterfly that's just basically pitched for a payoff if we get a reversion back to 4 months ago in the utilities.
And Rupert, do you
My
see that
sense
across
that
the world too? Like you mentioned the XLU, which is the US ETF, but are you going out shorting European UTs too, who benefited from data center views? Or are you thinking it's really the overvalue is the US?
it's tough to get an implementation that's easy for my readers to put on that includes those kind of names.
Okay.
You've got a liquid option chain around XLU, and actually that's where some of the biggest craziness has really been. So yes, there are IPPs and merchant power plays within XLU, names like Constellation, names like Vistra, and they will be beneficiaries from the power spend, but the rest of that basket are running regulated assets, right? And they've got aging infrastructure with increased costs of capital. They are going to become political footballs in the inflation fight going forward. They're not going to get to raise their prices on consumers. And I'm really happy to fade that on a short leash. But I'm not touching the stove of getting short the Highlander here. That thing will be it will peter out at some stage, as parabolas always do, and then I'll shoot it in the back. I've got no interest.
It's like a
I've
Tesla
got no
trade
interest.
a few years ago when everyone thought it was too valued, but that could stay overvalued for way too long.
But in light of this, considering Nvidia did a $10 intraday reversal today, I would say that the option market is the tail wagging the dog these days. Option volumes grow 10 to 14%, and then big OPEX days like this, you see this, and you just wonder with like the Highlander. By the way, if no one realizes, the Highlander is Rupert's trademark name for Nvidia, which he has a piece on his website report on.
Well,
let
me respond to one thing. So let's do some basic math. And this isn't about picking tops or anything. This is just math.
Yeah.
Nvidia is 97% above its 200-day, right? 97%. The last time it was here, it actually did achieve this one other time. The stock was worth $900 billion then, and now it's 3.3 trillion. So you have a $3.3 trillion company that's 97% above the 200-day. Now, to put that in perspective, what's the closest big cap comp to that? So Ben brought up the famous gamma squeeze in Apple September 2020. That was the SoftBank whale incident, and Apple did a split as well. And so you had this, Apple was 62% above its 200-day, and it only stayed there literally a handful of maybe 2 days. And so think about it. So this is, and then the most Microsoft ever got above its 200-day was 36%. So this shows you just like, okay, maybe it is a new market, but these are big numbers. So how do you keep like a $3.3 trillion company 97% above the 200-day moving average? It takes a lot of capital to do that. Maybe it's a different world now, but it's still tremendous. It's a lot of math.
It's flows, it's gamma trading, and it's career risk.
Yeah.
Right. And ultimately, I think that's a lot of what we're dealing with right now.
You wrote about it well, that there's career risk if you haven't been owning NVIDIA or LVMH, like bring it around the world, right? Or if you're in Asia, TSMC.
It was the Maotai. It was the beverage business. It's Maotai, Kuaishai Maotai in China, which was the A-share darling, right? The maker of Firewater, Baiju.
That's right. And so you gotta look at those, and until they move down for whatever force of nature, that people have to be in these, especially if you're running, like half of my money is running against a benchmark. I have to care what has flown, right, in each sector, in each country, especially if you're playing against the ACWI. And so how do you get a sense of then, if you can't use options, you can't short, you have some long only people, Like, how do you deal with this? Like, you've been around for a
Well,
long
they
time.
don't care. They don't care, Nadine, because they just fail together,
Okay.
right? I mean, I'm afraid that that's the reality, the sad reality of big retirement, which is that ultimately the cardinal sin is to be doing something different, swimming in a different direction to the market and fail, right?
But
If
then think
you
about it too,
swimming with the market and fail, you're
the
golden.
market's up a ton and you're not. People hate that more.
That's where you get fired. That's where you get fired.
Yeah. Yeah.
Larry, why don't you talk about, because we brought up this passive, and you've been on this on the chat and on Twitter about how the passive guys are getting ripped off as these guys are front running them. That's an interesting thing.
Oh my God, this just the inclusion, right, of the, say, look at Uber. It ran up 60% into S&P 500 inclusion. Lululemon went up, I think, 50% into S&P 500 inclusion. Super Microcomputer went up 300% into S&P 500 inclusion. So everybody is like gaming this inclusion game, and they're front running it, and so that's part of it. And then but we talked about in our book, there's 30 some odd trillion dollars that's tied to passive indexes. That's what Rupert's kind of getting at with these flows. So there's 30 trillion that's tied to passive now. And so that's all the copycat, or index, company ETFs that mimic the S&P, or all these companies that, I'm sorry, these other products or these other portfolios that basically mimic the S&P. And so now, if NVIDIA is now 7% of the market, it's gone from 1% of the S&P to 7% in like 18 months. And so you've got a real high beta, incredibly high beta name in a high beta sector that's now a huge component of the S&P. Whereas think about the last like 30 years, right? 50 years. Think of like what stocks led, the S&P. Like, what was the highest market cap stock? You're talking about Exxon Mobil's. You're talking about General Electrics, right? You're talking about Apple's or Microsoft's. You're not talking about a very cyclical, crazy sector like semiconductors, which is like the most. I mean, these guys at NVIDIA, right? I forget what we call them, the Highlander, but they have blown up investors like 6 times since 2018 with meta chips and all this. So I just think this puts a real wrench into the whole passive. I guess the passive fantasy that we're in.
Is there a chance that this could lead? Because again, I remember being in grad school, and it was the early days of factors, and it was the early days. Passive was a thing, but it was just a small thing. And look, Bogle had a good idea, but when it become kind of like the pod shops, right? When you're a minority player, it's a fantastic idea, but then you get so much popularity, like any carry trade, capital flows to it, and now you're so big, you're the actual dominant player of the market, and we get these absurd distortions, right?
Yeah, and so the top 3 stocks are 21% of the S&P now, right? You go back 50 years, the most I could find was the top 3 stocks. Like even in 2019, the top 3 stocks were like 8% of the S&P. The top 3 stocks were 8% of the S&P in 2019, and in 2000, in the 90s as well, 2019, whatever. You can go back. It's usually around 8 or 9 or 7% of the S&Ps in the top 3 names. Now it's 21% of the top 3 names. That tells me passive is broken, right? It's just completely broken.
But I have a question for you guys, because, of all the things we talked about, these are known knowns. Everybody knows about it. We're talking about it. It's being written about, charts everywhere, but still it's moving on, right? Like there's no dislocation going on of the entire market of these top names. And so, a question for you guys is that, and it goes back to the first one, right? Is that you've got bulls still moving this along, whether it's the forces of liquidity because of the labor, whatever. Well, all these different things that are moving it along, it's the time frame and knowing, like, how do you know when to get off this road? Because this road can't go on forever. But these are known knowns, so people are still in. Is it just, as you're saying, I've got money in 401k, I got to put it to work, or it's career risk and I got to stay in until it doesn't work? I'm still kind of struggling with that because these seem to be known knowns.
Yeah, I mean, timing tops is, well, it's been a mug's game for the last couple of years for a start. But the problem with, well, listen, I've got a universe of holdings of companies trading on 3 times cash flow, and I'm just going to hide out in them and wait for the party to end over in semiconductor land. No, you're not, because those things are going to go no bid as well.
Right.
When this train turns, you cannot be waiting for the party to end by hiding out in value. In all probability, I think you or you need to be sort of lowering your bar to sort of 1 times free cash flow, where you really are in cigar butt territory. But I think it gets back to what I was saying, is just play the game on a very short leash.
Right.
And it and with occasional, when the stars and the moons line up and go, right, listen, for this party to continue, 6 out of the 7 following things have got to go right for the Highlander this week. Right. And at that point, you play small, but you take your shot, right? And expect to lose 2 or 3 times before it happens.
I want to go to you. You have such an interesting background. Maybe talking a little bit about your views on India and China, just because some people hear about it here, and we know what we're reading, but you've been more on the ground. Is there anything going on there that you think, like your short India call or otherwise, that you think that people should be paying attention to, that maybe they're starstruck over here in NVIDIA, but they need to be looking elsewhere?
Well, listen, if you think that NVIDIA is a crowded trade in the context of US equities, you should try India for size in the context of global emerging markets. Now, just to be clear, I'm not short India. I had a go last year. I think that the India story is I mean, I did a lot of business in India over the years, right? India is a phenomenally difficult place to do business, and I did work with public sector companies and private sector companies over the years. The 10 years of Modi has been a period of significant nominal growth, but let's be very clear about what the Indian economy is. This is an economy that is designed to benefit a plutocracy at the top of it. You've got Gini coefficients that are off the scale, and nothing's been done about them over the last 10 years. Yeah, it's all very well pointing to demographics about a very young and educated and English-speaking population, but unless they've got productive jobs, you've got an Arab Spring problem on your hands. You've then got an economy that is a net energy importer, and this year will be a net food importer, possibly after a weak monsoon. Their status as an importer exporter of food is a function of a 3-month weather event every year, right? And we're entering a period of extreme weather volatility, and we've already seen numerous examples of that. Then, and I'm not going to bring us back to AI, but the 30%.
I'm kidding.
No, don't do it. 30% of India's exports are ICT related. So it's call centers in Bangalore, right? If there's any business that is likely to be, completely revolutionized by AI chatbots, it's going to be those businesses. And so you've got a situation where the whole market is, trading on 23 times. It's trading at such a premium to EM, but also at a massive premium to the original 800 gorilla in AM, which is China. And the premise is that we've had this revolution in terms of sort of deglobalization driven by populist politics in the West. Are we really believing that those blue-collar workers in the Rust Belt voted to have China's role as the world's factory to be transported a few thousand miles further south to India? No, that wasn't the deal, right?
No.
They want those jobs back in Michigan, right? So the premise that, we're just going to see, India becoming this manufacturing supply chain champion. Well, you don't do that without significant fiscal investment in the infrastructure that allows a supply chain. I mean, I spent most of my working life working with Chinese corporates, and spent time working in Chinese industry. The infrastructure that makes that work does not get transplanted to the South Asian continent overnight, and everyone's pricing India as though that's a done deal, right? And
we see headlines here, right? Microsoft's going to spend this, and so is going to spend that, and so people are, I think, are just assuming that
they couldn't make the iPhone in the US if they wanted to. You really think they're going to fucking make it in India? It's not going to happen.
Also, India's notorious for options. Their option volumes just like the Highlanders.
Oh yeah. So that is another thing. So the growth in retail participation in markets is a big part of the move in the last year, and this is a new investor class that has yet to have its encounter with the first punch, right? And we all, as Muhammad Ali would say, and it's not like they're not like the buy the dip traders of the US of the last 2 to 3 years. They're newbies to the market that have never seen a dip. Right.
But it's when it personally versus seeing it somewhere else, so you maybe make different choices.
Yeah, and the other thing I'd say is that the currency. I mean, the rupee has been a serial devaluer, and I think it's held in well since the Ukraine war started out, because they got this massive energy dividend in the form of cheap Russian oil. A tough harvest, a spike in energy prices, that currency's off to the races again. And I should point it down that way, but yeah, USD INR up.
Yeah. And can I flip it over to Larry? So going to the opposite end, Brazil, right? And you compared commodities and Brazilian assets as, and talking about flags when looking at those two things. And that, in the last month was an underperformer relative to other EM. You look at year-to-date Mexico and other areas and look at Brazil. How does somebody think about Brazil and the timing of when you jump in, or, given the metrics that you like to look at?
Okay, so let me just address EM first and then Brazil. So one thing, we went back, over 30 years, and we looked at, at the end of hiking cycles, you really want to own local currency bond funds, or back, they weren't around 20, 25 years ago, but they're around now.
Yeah.
So your EMLC has been hammered by higher for longer talk.
Yeah.
And to me, higher for longer blows up the middle class consumer, blows up the regional banks. So there's a lot of things. If they really do go higher for longer, they're going to blow up the U.S. Obviously, interest on the debt's going to go close to 1.8 trillion a year. So higher for longer has been preached. They're using their vocal cords. That's pushing down the value of local currency bonds. So your EMLC is now like 6.5% yield. The bond fund's been beaten up because of the dollar. And so typically that's a great time to buy local currency bonds at this point of the cycle. It doesn't mean it's going to work today or tomorrow, but you do get a huge dividend while you wait. And you get this, if you look at the fund, there's like 240 bonds in there. Like, they have, all kinds of local currency bonds, including Brazil, including Indonesia, including, Malaysia, according all.
It's a good product. It's a really good product. It's basically the JP Morgan EM index, local currency.
Yes, exactly.
Right? Yeah.
Exactly.
Yeah.
And then, but Brazil, so the Brazil banks are in the buy zone again. They're ITAU, and they're Lula. He's made some moves. He's gone, a little bit more vocal and a little bit more aggressive. His move with Petrobras, and he's scared people. And like I said, we run a Bloomberg chat with institutional clients in 20 plus countries, and there's a lot of wait, perhaps 5 or 6 families or funds that are in Brazil that are in the chat, and we've had this debate the last couple of weeks, like what's really happening in the legislature. How much control does Lulu have? And I'm really getting this kind of, it's like you said, it's very washed out relative to the rest of the EM complex. Commodities, the BCOM is, Brazil has a very high component, I think 60-70% of GDP is commodities, right? So commodities have been beaten up a little bit with the stronger dollar. So you're in this kind of zone where you should be buying Brazil because it's so cheap. Doesn't mean it could get cheaper, but it's just so cheap relative to the rest of the EM. And you've had like this kind of like, not a perfect storm, but you've had a collection of things in the last 2 months, whether it be higher for longer promises that hurt EM, hurting commodities, and the political moves by Lula, and that's kind of like scared a lot of money away from Brazil again. So yeah, I'd be looking at the Brazil banks.
I like the Brazil. I like the Brazil trade. I actually was in it late last year and then came out of it earlier this year. I think that another thing in its favor is that I think that, talking of commodities, I think we're about to see an explosion to the upside in grain markets, which is obviously a big where Brazil will be a big beneficiary there.
Right.
This is a trade that just looks absolutely on the ropes, dead and buried right now, but a combination of largely weather related and information inefficiency issues could see a massive inflection there.
What are those information inefficiencies for those who maybe don't follow it as closely as you?
Well, I mean, a bit like the Bureau of Labor and Statistics, the IEA for energy, the USDA is in the business of inflation information suppression, in my view. And they are not prepared to concede that the Brazilian second crop corn is going to be way below where the market has. They're not prepared to concede that the Russian wheat harvest is an absolute disaster, right? Which massive in a world where stocks to use ratios are at multi-decade lows. A 15 million metric ton miss on the Russian winter wheat market just changes things overnight. It puts $4 or $5 on the wheat price in a very short period of time.
So you understand this as somebody who's trading it, and the government may understand it but not want to show it. But how about companies who need to hedge out these risks or think about their inventories, and whether they're selling machinery that deals with crops or the like, are the companies in on this game too, or is it you expect to see surprises for them?
I think at the moment the agri-business equities are all trading in sympathy with the grain prices right now. So you see that in the fertilizer stocks, you see that in Deere, in Agco, and the likes. But there's been a lot of chatter about sort of collapsing farm incomes. And yes, they are going to be significantly lower than they were last year, but they're still going to be 10% above the 10-year average, right? Farmers in North America have a lot of people rooting for them in Washington, and they generally, they are asset rich and often income poor, but ultimately the stocks of these the stocks are reflecting a sort of an Armageddon scenario in terms of farm incomes.
Well, I was just looking at Vale. So you're talking about metals now, but net gross indicated yield on Bloomberg is 9.67%. Oh my God. I mean, that's price for a dividend cut, right? It's massive political risk. So that's telling you that Brazil is for sale for sure, and probably a buy.
And let's just talk about
the Latin one I like is Mexico. You've got too many people trading their politics these days, right? And not doing the work. Scheinbaum is a continuity Morena leader. Yes, the pollsters got it wrong again, and she got she had a bigger win than people were expecting. But ultimately, EMs know what their constraints are, right? They know that they cannot, piss off the bond market. Ultimately, there's a big narrative. Oh my God, Mexico's fallen to the communists. No, they haven't. Scheinbaum's like a European technocrat centrist, right? Yes, she studied sort of climate science at university, which paints a target on her back for a big part of our community. And maybe it will be a bit tough for some of the miners in Mexico, but I don't think we're looking at revolution there. And for the market sell-off was really exacerbated by the greedy pigs, as Ben calls them in the carry trading markets. But and that was a really crowded trade. But ultimately, the story hasn't changed. So I'm long Mexico as of last week.
It's an
I
interesting
like that.
thing to think about with the care. I'm looking at our peso yen working for us here, Rupert. And
Thank you.
but we've had some unwinds, right? Copper, Nadine and I on the Wall Street Beach show, we actually got lucky and top ticked it, and tried to tell our subscribers to buy some risk reversals that day. And better to be lucky than good, right? And oil corrected and gold kind of digested. I'm not as much into the weeds on the agriculture as Rupert is there, but he's saying there's a bull structure. We've seen the cocoa and how that did. It had an unwind, but that's not going to correct. You don't get new trees.
No, you don't grow trees overnight.
Yeah, and Larry's book, in Larry's thesis, has been for a while, is that we're going to get money to more shift to commodities. And so maybe the market, this oil move, I think, is very interesting. Because, right after the OPEC meeting, I see a chart that says there's no bulls left. The bulls have been eliminated from the positioning data. And everybody's like forgotten about oil. It said $72. Now we're back at 82. Strong dollar, strong gold, and strong oil. This is the scenario I don't think anybody wants, the redux of 22. But this commodity bull market, Larry, you don't think it's done? We got legs to go here, don't you think?
Well, yeah, it's classic. It's just classic end of the hiking cycle where the Fed knows they can't hike anymore for a whole bunch of different reasons. In election year, you got the middle, obviously the bottom 60% of consumers been going on. The regional banks in flames in some ways. So that's a classic commodity suppressant. But once they admit that they're on a path, an easing path, and when all the Fed governors, when there's not a lot, when there's no, when they're in unison toward a easing path, that's when the commodity trade really starts to work. And right now, we've just been in this period where the Fed's going back and forth, good cop, bad cop, every 3 or 4 months. Good cop in December, bad cop, the last month or two, and so it's going to be in a massive trade, but we really need the Fed to admit that higher for longer, or once they break something. Now, once they break something, commodities get cheap because the correlation starts going to 1 and commodities cheapen up. But this time around, the deficit, as you saw yesterday with the CBO numbers, we're talking about World War II type, definitely recession type deficit spending while we're at full employment. So this time around, commodities are gonna have that, massive support that they hadn't had before. That's why we probably, right now, if you look at the S&P 500, industrials, metals and mining, oil and gas are only 14% of S&P 500 composition, 14%. And then in say the 1980s at the end of the last commodity bull cycle is 49%. So in the book, we don't think that we're going back to 49, but is the S&P 500 composition 5 years from now? Does it go from 14 to maybe 28, 29, 30? Yeah.
That's a big fall.
I could buy that.
Yeah.
I mean, I think for me, in terms of, financialization of the whole economy, so much, it's a circular reference in an Excel spreadsheet, right? Stock market go up, people feel richer, people spend more, people stock market, and the whole incentive structure of US CEOs is all about, share price, total shareholder return. And so, everything is indexed in the economy towards moving share prices up. And the only thing that starves the oxygen from that, to my mind, is 401k contributions at the top end of the wage scale. And so that for me is the catalyst for, the end of cap weighted dominance. And then we can see some kind of rotation. And it will be, it will be a healthy rotation. But I think it's not gonna happen without that liquidity spigot being shut down, or at least constrained a little bit.
I mean, gold. What about gold here? Gold's had a great move,
It's had a
and
wonderful move. Listen, I'm long in the do not touch book, but I took off the tactical position when the Chinese announcement is now. Let's be very clear. The PBOC is not the only arm of China Inc. that buys gold. You've got retail buyers. You've got the PLA. PLA's got as much gold as the PBOC. And as the only advertised wholesale buyer of gold in the market, was very much in their interest. They want to buy more. They have to buy more. Why on earth would they be bidding against themselves for it? And so, I mean, I had, as a tactical trade, it was an August call spread on the GLD, which was working phenomenally until the China news came, but there was no way it was going to ultimately work properly by August. So I've withdrawn to the sidelines on that. I just think, the reality, the run up in gold had nothing to do with real rates, if we believe that real rates are meaningful anymore. It wasn't really participated in by any Western money. If you look at the shares outstanding in GLD as a proxy for that, so it was really central bank buying. And if the largest of those central banks says we're off the bid for now, I think you just have to sort of take a breath.
But what's interesting about that was, if you look at the moment the Ukraine war started and we seized the Russian assets, those two drivers, which is the ounces of gold in the vault with the GLD and the real rates, this historical pattern that had held forever, disconnected. And you don't, I don't know, Larry, what do you think? You think guys saw that and they're like, we can't trust these guys anymore, we got to get into the physical market? And what would change that? Why would that trend change?
Yeah, think about it. It's a 16 and a half, almost a $17 trillion swimming pool, right? And so if you look at the gold to platinum ratio, that is the most extreme we've ever seen. This gets back to what Rupert's talking about, how, gold's just such a global big swimming pool that the irresponsible posture in Washington has freaked out some global investors, and they're just crowding into gold. Whereas all the gold ever mined in the history of humanity, everybody knows this, would fit into an Olympic-sized swimming pool. But all the platinum ever mined would only go up to your ankles in that pool. And so you're seeing this incredible spread between gold and, say, platinum. The gold platinum ratio is telling you to sell 20% of your gold and buy some platinum. Same thing with gold silver. The gold silver ratio is not as extreme, and it actually broke a key technical level.
But that is an incredibly logical point. Right now, central banks only buy bullion. They don't buy GDX. They don't buy GDXJ or SILJ. They don't buy platinum. And it might, the Chinese haven't bought silver in size since the 17th century. So
right.
There is no second derivative. And so everyone was screaming for 6-9 months about, when are the miners going to catch up with this move? Well, the biggest buyer's not buying the miners. We just got to wait for that big buyer to come back to the table. But
miners haven't done well historically.
I think independently, the next catalyst could be some kind of shift in mindset by Western investors. Right now, we're all in a cozy huddle of agreement that it's a great asset to be in right now, but everyone else owns the Highlander.
Yeah. Well, we've been around the world, different EM. We've been in the States, gone through the sectors, long, short, thinking about options, thinking about stocks. And I think one of the more important things is, as people have listened to you both and obviously heard some really high quality insights and understanding of your thought processes, how can people find you? So maybe Larry and then Rupert, each of you talk to us a little bit and let people know, how do people find you? How do they read or consume or get to know you better and what you do?
Well, our first book, I'm really proud of. Our first book was the Lehman book, and it's now been published in 12 languages. It's called A Colossal Failure of Common Sense. It's one of the best-selling business books in the history of finance. It made the CFA Institute top 20 all time. That was our first book. It's A Colossal Failure of Common Sense. Our new book is When Markets Speak. It's here. It's done well. It's been in the top, 5, 10, number one for a couple of weeks on Amazon and finance. And, we're really excited about the new book. It just came out, and we had great endorsements from Mark Cuban, Gillian Tett, Neil Ferguson wrote the foreword. So we're really proud of the book. And what's nice is it's what we do at the Bear Traps Report is crowdsourcing intelligence. So imagine like having a room with like 20 or 30 Ruperts and Bens, and so we have really smart clients around the world. It's like a live ideas dinner. And so in the old days, we would go to Ben Benson's in New York, but now we run this conversation behind us. And so there's a lot of pension funds, mutual funds, and hedge funds in there. Some of them that don't say anything all year. They may say Happy New Year, Merry Christmas, but then we have like 30 or 40 thoughtful contributors that are part of the conversation, and we recap that conversation for the retail or the family office that's not on Bloomberg, or the financial advisor. So we're at the beartrapsreport.com. You can Google us, and we really appreciate you having us on today.
How about you, Rupert?
I'm really easy. Blindsquirrelmacro.com is where you can find me. I put out a lot of stuff for free. There's also a weekly podcast, which is kind of sort of an audio version of the free letter, and that represents about sort of 40% of what I write, and the rest is behind a paywall. And people that subscribe to that can join a Discord room where I'm there every day with a bit of snark. I'm based in Australia, and so I tend to emerge towards the US close and chat with insomniacs like Ben through the night.
Well, awesome. Thank you, Rupert Mitchell and Larry McDonald. This is the end of our first episode of Just Think About It with Nadine and Ben, and we hope you'll come back and we can explore some of the same topics and new topics in the months to come as our elections, the geopolitics, the dollar, everything unfolds, and some of the data either proves out or not to some of the things that we talked about today. So thank you so much.
Yeah, thanks, guys.
Thanks,
okay, great to see you guys.